Hey, welcome to this week's video. One of the common questions I get is that we're making a profit, but I'm not seeing the money in the bank. And like the old commercial, where's the beef? It's often, where's the cash? So often the reason is there's a difference between cash flow and profit. In fact, when I review financials, the cash flow statement is often where I start. And especially as an auditor, when the cash flow was negative, but net income was positive, it was definitely a red flag to look at. So in this video, I'll explain the main differences and better yet, what you can do to make sure the cash you're seeing is what you expect. So let's get to work. So profit is simply revenue minus expenses, right? But there are actually two ways to measure profit. One way is a cash basis, and the other way is called the accrual basis. Quite simply, cash basis is when you record the ins and outs of the transactions based on the ins and outs of the bank when they incur, when you spend money, when you receive money. Accrual basis, on the other hand, is when you record revenue and expenses when you actually incur them, when you actually ship the product, or when you receive product that you use in production. That's when you record those transactions. An example would be payroll. You may incur payroll costs throughout the month, and towards the end of the month, you may incur payroll costs but not actually pay them till the next month. Under the cash basis, you would record the actual expense of the payroll in the following month, where in the accrual basis, you would record that in the month that you incur it. So I'll include a link in the description on a video where I go in a little more detail on the cash versus accrual basis of accounting and which one is right for your business. So for now, it matters if you're using accrual basis or cash basis of accounting for your cash flow statement. But there is another problem that is usually the main issue when it comes to profit versus cash. The issue is the balance sheet. You see, some items on the balance sheet are not reflected in the P&L statement. This is where your leaking of cash may occur. And to kind of drive this point home, let me give you an example of what those differences could be and what you can do to look at your financials to see if you have something similar. Okay, let's say your profit is $55,000 for the month. That's what should be in the bank, right? Well, let's start with this profit and let's add and subtract items that may be causing differences in what is the profit you incurred and the cash that went in the bank. So we first start with the $55,000 and add back any non-cash items that may be in your P&L statement. And for the most part, this is always going to be depreciation. Depreciation isn't something that you actually spent cash on, so it was a non-cash item that you have to add back. Now we turn to the balance sheet. And the first thing we see is receivables went up by $5,000. This means that we recorded revenue but haven't yet received the money. So we need to adjust our cash. Receivables up or down is going to impact your cash on a monthly basis. Now, if you're on the cash basis that we talked about earlier, this would not matter because you're getting the cash and recording it when you actually get the money. But other things on the balance sheet can also impact cash flow, such as items purchased in advance, like inventory, which in this case went up by $8,000. You see, this doesn't hit the P&L yet because you haven't actually utilized that inventory or sold that inventory and has not been recorded in your P&L statement. So that is an adjustment you need to take into consideration. Another one is equipment. I hear they purchased $10,000 of equipment, and this expense is not in your profit and loss statement, but will be in your profit and loss statement over time, utilizing depreciation, which we talked about a little bit earlier. Payables went down by $7,000. This means that we paid down items we owe, such as accounts payable or maybe a credit card balance. Again, if you're using the cash basis of accounting, this wouldn't matter as much as you're recording expenses as the cash changes. But if you have a balance that is increasing in credit cards and you decide to pay that down, then that is going to impact your cash, and you want to take that into consideration in your cash flow. Also, debt here went down $3,000, similar to the credit cards, but this came straight from the bank. Sure, we have interest expense, right? That interest expense is in the P&L, but the principal part is not in the P&L. So you're going to want to take that into consideration in your cash flow statement. Owner's distributions, in this case, was $15,000 for the month. A lot of times owners take money out of the business because they know what the profit is, so they think they can take out a certain amount of money, but when in fact that actually they're taking out too much in the business. So a cash flow statement will help you in seeing how much you can and cannot take, and it also kind of shows you that I took too much of distribution this month or too little of distribution a month, and you can see that in your cash flow statement and adjust your distributions accordingly. So as you can see, in this case, we actually made a profit of $55,000, but only $10,000 actually made it into the bank. This is why having and reviewing your cash flow statement is critical, so you can understand that, okay, I made $55,000, but only $10,000 went in the bank. How can I get that number to be higher? So how can you better manage the cash flow? Well, this is where cash forecasting comes into play, and I recommend you look at least 6 months or maybe even a year. And this involves forecasting revenues and expenses and how that impacts your balance sheet. You can do this using a spreadsheet. We actually help our clients do this by running different scenarios and software we use, and it'll show you what your revenue and expenses will be, but also what on a monthly basis your cash flow should be. You could also leverage the use of bank accounts. And while I still recommend doing a cash flow projection, you could set aside money in specific bank accounts for specific uses, like purchasing equipment. This way you know that I have money in this account for a particular item that I want to utilize that money for, and I have enough in there. Or if the money is not there, then you know that something may be wrong in the business. Profit First is a good example of how you might utilize this method. And I'll include in the description a couple of videos I did on how you might be able to accomplish using Profit First or using an alternative method that I recommend as well. So in summary, get an understanding of the differences between the profit and cash flow in your business, and make sure that you're actually getting an accurate cash flow statement so that you can review this on a monthly basis and see where the cash is going. Once you get that statement, you'll get a better understanding of where is the cash or where isn't the cash. And I also recommend that you project out your cash flow so you can anticipate and plan for inflows and outflows of cash, including when that you can bring on hiring help or other investments that you might want to make in your business. Okay, that's it for this week's video. If you got any value out of that, it would be awesome if you hit that thumbs up. And if you haven't subscribed, love to have you aboard as a subscriber. Until next time, I'll catch you on the next one.